Synthetics in options trading. What are they? How do they work? And how should we look at them? Let's unpack it all after the bell. Yeah, still here.
This is perfect to talk about the Y'all Exchange. Welcome to Y'all Street.
Y'all Street. What's up, Cowboys? How we doing? Good. Another fine Thursday. Here we are. Well, here's the deal. You ready? This was a Reddit post, and it's kind of paraphrased, what the post was, is exactly how it looked. But question is, which is a riskier position? An at-the-money covered call, a short at-the-money put, or are they the same? And let's assume that the at-the-monies are the same expiration. So it's the N equivalent strikes. So let's say it's I drew it up as a 225 covered call using the 225 strike, okay? Or is the 225 put being short that, or are they the same? Okay, good.
Okay.
That's what made me think of synthetics, because guess what? When I first got into the business 120 years ago, I was taught synthetics first. Weird, right, Mark? Being a market maker. Maybe not weird.
No, not at all. I was taught synthetic. I was just reminiscing about the synthetic sheets we used to have to fill out as trainees. We would get a big list of them, and how quickly could you do the synthetics on 50 different stocks?
Right. So, yeah, exactly. So my backer and mentor was a huge money play guy. So he did a lot of conversions, reversals, baskets against the indexes, and that sort of thing. So, all those little minutia parts of calls or puts or calls. You can make synthetic stock out of calls and puts, et cetera, and trade it with real stock. He was scooping up little bits of premium. So he wanted me to understand that intimately. So that's what I was taught first. So back to the question. I mean, Mark, I'm going to give this one to you. What's the answer here? And we'll go through it.
Well, a call is a put and a put is a call. So
these are the same. Okay. Now, my answer on Reddit was this. These have the same risk profile because the covered call, a short call, long put, is a synthetic short put. And he's asking, or he or she is asking about the short put, which is the same thing. Okay. Now, my caveat was that a retail broker may margin this call in the covered call differently than just a simple synthetic short put. That may be the case. I don't know the answer to that one, how each brokerage works, but that could be a possibility. So in terms of margin, it might be a little different to the clearing firm or to the brokerage firm. Make sense?
A little bit, yeah.
But at the end of the day, I mean, a short put, the most you can lose is the price of the stock, which in theory you've paid for if you own the stock that you're writing the call.
That's right.
So I agree with you that there will be technical margin differences, but at the end of the day, from a dollar standpoint, no matter what vol does, that put can't be worth more than the strike.
So what I was hoping we could do too. So I think we all agree on this one. What the answer is. I was hoping to go through the three main synthetics. And what I mean by that is, let's look at synthetic long. Well, I guess it's four: synthetic long stock, synthetic short stock, a synthetic put, and a synthetic call. Okay, those four kind of get us into the ballpark of just about everything. What I will warn viewers of is that there are other things that you can look at, like boxes. Okay, and you can look at a long butterfly and a short butterflies on the same strikes that turn into two boxes, that sort of thing. We'll get into that in another episode, and that's kind of fun stuff too. That is especially helpful, the box part of it, when you're trading 0 DTE and you do not have enough money to be not flagged as a pattern day trader. You can use boxes to get out of your condors, which is interesting, and avoid that rule. But again, another topic on on that at another time. Okay.
Rule that is changing, by the way. It's going to be a lot less.
So yeah, did the commission come out and confirm that, or are they just kind of hinting at it?
I believe they indicated they're moving to 2,000. Yeah.
Oh, that's great. I don't know why we even need 2,000. You know how I feel about it. I don't think you need anything, but okay, I'll take it. So, well, again, another good episode on PDT. Mark, it was your letter that helped me write my letter that did it. We put us over the edge.
We tipped FINRA over.
We tipped FINRA over on that one. So good. Okay, so here's a point from Doug. Same plus or minus skew. I think he means
forwards.
Well, let's Doug, hold that thought. Okay, we're going to tackle that, but let's look at this a different way. Okay, what I'm going to do is I'm going to share the screen, and of course I didn't do this beforehand, but I'm going to do it now. And we're going to share. Guess we're sharing the remarkable. Oh my God, let's go to it. Here we go. Oops, I'm going to add it to the stage. There we go. All right, can you guys see this? My chicken scratch. Okay. Here's what I did. In this column, we have the calls. Oops, it's not drawing. Why isn't this drawing? Hold on. Sorry, I'm not drawing. I don't know why. Sorry, my bad. Okay, there we go. This column, we have the calls. K is always representative of the term strike, just from old days. And P is for puts. Strikes down the minute. I only did 3 strikes, just so you get the idea. So what we're going to do is we're going to get the synthetics of each one of these. Okay? And we're going to show you how you calculate this. It's very simple, right? And what a lot of people ask me is, can you add extrinsic value and intrinsic value as columns on your option grid or option chain, right? And I'm like, well, you don't really need that. You can just look at the price of the put or the price of the call, and we can figure this out. But and they say, oh, I don't get that. So let's go through it. So what I did is I took this. This was a real example at one time, and this is 1 day to go. So that's important as well, because Mark's going to explain interest rates and dividends on this one too, because it does factor in. So 1 day to go. No real interest rates. I know there's a little bit of one, a few pennies, and no dividends. Okay, so this is about as absolute as it can get. Okay, so there is a little bit of interest, but we kind of wiped that out for now, just for illustrative purposes. Okay, let's look at the 220 call first. Okay, remember, short call 640 and long stock 226, right? We said that's the price of the short put, or that is the short put, right? That is a synthetic short put. Short the call, long the stock, right? 1-to-1 ratio. Whatever the strike you're talking about, that's the equivalent of being short that corresponding put. Okay. And you're short it for 40 cents. How do we know that? Here's how you compute it. Okay. You take the call price plus the strike price, 640 plus 220 is 226.40. And you subtract the stock price, 226. That becomes 40 cents. And that is what the synthetic put is trading at. And that's actually what the real put is trading at. Amazing, isn't it? Comments. Mark, Jason, anything.
Computers do a good job of this. They don't want you to arbitrage.
Yeah, well, yeah, exactly. Now, and I'm going to answer Doug's question in a second. Mark, any comments on this one?
We're doing interest and dividends, or just with 1 day, we're assuming no divs getting paid, no interest.
Yeah.
Give me the interest argument right now. Let's say it's 10 days. What happens to this equation a little bit? It doesn't look like it's exactly the same, right? It's going to look like you're paying too little or too much for something because of interest.
Yeah, I think it all comes down to, forward value. And, in this interest rate environment, a $200 stock at 10 days is going to have a couple pennies of interest. So,
for sure.
Actually, it will show up even in your weekly trading.
Yeah.
But essentially, I like to think about it as what is going to be the forward value of that stock at expiration, because these puts and calls are going to expire based on what their, what the underlying is worth at that time. And, there's early exercise, of course, or whatnot. But thinking about the forward value, we will add an interest rate to that, future value, the risk-free interest rate, over 10 days on a $226 stock. So that's going to increase the forward value of the stock. And then the dividend is going to drop the forward value of the stock, because a call holder, a put holder, you're not entitled to that dividend. Sure, the underlying holder does, but where the mark of that stock price will exclude the dividend if the dividend is paid or recorded before expiration. So we want to add the interest and subtract the dividend in dollar and cents terms to the stock price to get that forward value.
That's correct. So that value that I just did, that computation I just did, will be affected by interest rates and dividends, if there is one. Keep in mind, not all months have dividends in them, so you have to be aware of that. Okay, so that's important. For illustrative purposes, though, I chose something without a big interest rate and a big dividend, just so you can see how the synthetic works. Okay, here's another trick. Okay, synthetic long stock. That is long a call, short a put, same strike, same expiration. So let's see if that works. Let's go back to our math. So the way we compute synthetic stock, okay, is call minus put plus strike. There's other ways to do this. This is the easiest way, in my opinion, because it's going to take advantage of the sign, negatives and positives. So let's look at the 220 line again, because it's easy math. Call minus put, 640 minus 40 cents. What value is that? $6. Add that to the strike, 220 becomes 226. What is the actual price of the stock? 226. Okay, again, interest and dividends will make that a little different. Okay, so that synthetic's the same. Now back to Doug's point about skew, and I think I'm going to interpolate a little here. Same skew, etc. So I think he's asking, does skew affect this? Let's pretend that's the question on with skew. It actually doesn't, because remember what Mark said earlier: calls and puts are the same thing. So if you're looking at skew, and the puts are skewed to the downside, so is the call. The call has to follow suit, because this relationship has to exist. The synthetic, it has to exist. If it doesn't exist, Jason made a good point, there would be an arbitrage, and computers will not let this happen. In the old days, when Mark and I were down on the floor without computers, at least when I was, maybe Mark wasn't, you could do these things in your head, and you could gain edge and lock in dollars with these conversions and reversals, and you would not believe it. A man figured this out, that this was a relationship in the early days of options trading, and he was doing these things and locking in dollars because these are so mispriced. Well, as you know the story, computers came along, people got smart, option model came along, blah, 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 and we figured out what synthetics were, and all these relationships exist together now. So they never really get out of line. Safe to say, guys, right?
To the extent that they get out of line, you've got to be asking yourself, am I mispricing the borrow rate here? Is that about to move? Or am I miscounting a dividend?
Yeah. And there's a horror story in my life about how much money I lost because I mispriced the dividend. There was a special dividend that was going to be issued, and this conversion reversal got a line, and I thought I was just scooping up edge. And then after the 1,000th one I did, I'm like, wait a minute, this is too good to be true. And guess what? It was. They announced a special dividend, not enough to adjust the strikes. That was 10% rule back in the day, and I got hammered. Okay,
there's somebody on the other side of Lex going, yeah, that's
right. And this was, it's probably Goldman or someone like that who knew. Wasn't illegal, just was the deal. What I should have done is said, wait a minute, this relationship exists. No one's giving me free money. So what we started doing is we were buying the call, selling the put, and selling stock. Dividend goes up there, bad news, right? I started buying the upper put, selling the call, and buying stock to get into the box, the long box, so that I could hedge that. And I just didn't get enough of them up, okay? Viewers, ask a question. I know this is tough. It's okay. Don't be afraid. We're not going to make fun of anyone except Jason. Just kidding.
With computers nowadays, all of this is so solid. I think the last time I did a synthetic was on Verizon stock, because their dividends were only going up, and there was some kind of news a couple of years ago where there was some, like, they had to replace all their copper with fiber or something like that. And the assumption was that they would have to cut their dividend, but Verizon doesn't cut their dividend. They raise their dividend.
Right.
And so that was the last time I used synthetics on anything. I bought the stock and did a synthetic short, and collected that difference. But that it isn't like this is risk free. Like if that dividend did drop, then I'd be done for. but you know, that's, you know, it's you know, a lot of I'm shocked that you said that this was kind of on Reddit, because this doesn't seem like a Reddit type trade.
Well, I think
exactly YOLO.
Yeah, no, I think the point of the Reddit post was that you know, look at most of Reddit that I find, you know, when I get questions is they're pretty beginner questions, which is fine. That's, you know, you got to learn. I get it. And it was a beginner question, and I'm not sure the person was trying to trick people. You know, is it the same? It's a short, you know, it's a synthetic short call versus a real short call. I don't know if he was trying to trick. I think he or she was trying to just understand better. So I did my best to explain it in 4 lines, and I hope I did. But they are the same, right? Those are synthetics of each other, and they have to be related. Let's look at another one. Let's do a synthetic call. Okay, so that's a little different. If you look at the screen, it's the last one. I kind of squeeze it in there. So the synthetic call is the put plus the stock price, okay, minus the strike. I think I wrote that wrong. This is strike minus K, right? So let's take a look let's try one, see if it works. Okay. Let's do the 225. So remember what I said, put plus strike in parentheses. So put plus stock is 226. That becomes 227.40. Okay. Minus the strike of 225 is 240. Well, look at that. That's where the call is trading. Amazing. Amazing. So the synthetics are this. Short call, long stock is a short put synthetically. Long put, long stock is a synthetic long call. Flip those all over, and it's the opposite of what I just said. Long call, short stock is a synthetic long put, right? Short put, short stock is a synthetic short call. You can lock all this up if you wanted to by buying the call, selling the put, and selling stock, or buying the put, selling the call, buying stock. Synthetic stock is the call and the put, opposite side. So if you buy a call, sell a put, that's synthetic long stock. If you buy a put, sell a call, synthetic short stock. The natural head is the opposite in each of those. And the relationship has to exist that any of those combinations has to roughly represent what the real entity is, less dividend and interest, or not less, but including dividend and interest. Okay. And this stuff rarely gets out of line, I would tell you. Okay.
Yeah.
And I'm going to throw one more wrinkle in it, and then we're going to take a breath. The last wrinkle. If you buy, I'll just write them thing. If you buy this butterfly, okay, and I'm just going to do it with the signs, and you sell this butterfly, okay, this becomes 2 boxes, and those prices have to be similar. Okay, so think about this. All of these things have to work in unison, irrespective of skew. Skew can go up, skew can go down, but everything has to move together in this thing, because this butterfly would be out of line, this box becomes out of line, these 2 boxes become out of line, and then any of the relationships across the strikes and across calls and puts get out of line. It cannot happen. Okay, so keep a thought on that. Any comments, guys?
I'll say that, you know, this seems like a bunch of math and wonky, like pricing arbitrage relationships, but if you take the perspective of long stockholders, there's some really useful intuition to it, because like, what are the 2 most common strategies you're going to do if you're long stock? You're going to sell a call, or you're going to buy a put. And if you hedge long stock by buying a put, it's the exact same position as owning a call option on that stock. You have no downside below, you know, the strike or whatever, and you've paid a little bit for that, and you get all the upside. That's just a call option. And same as if you take that the other way and you own stock and you sell a call against that, you're just short a put because you have all the risk of the downside, same as a stock ownership, same as like a short put. Mm-hmm. And you get that little bit of premium, which is the offsetting amount. And that's so right. Like those 2 strategies are, you know, your P&L profile is the synthetic. And I think that's, you know, a good intuition about what exposure you have when you're executing those simple trades.
Yep. That's a good point. And I would say, you know, Jason, you chat with a lot of some of the more beginning people, I would think, as well. And so do I. You know, the takeaway here is wow, Lex, that's interesting. Thanks for all that. I'm never going to use it. Okay, I get it. You're probably not, truly. But the point is that the more you understand the relationship and the inner workings of all these kind of relationships, the better you get at options in general, I think. Right. And you're right. As a retail person, you're never going to have an opportunity to use this to your advantage in terms of arbitrage. It's not going to happen. I get it. But understanding the relationships is in my opinion, really important. And when you can do that and you can do it in your head, now you can look at other things. And all of a sudden, you could do this with time spreads, believe it or not. It's two boxes potentially. You never know on all this stuff. So there's all kinds of relationships that exist there. You can do this. We got so good at doing this in our heads because we learned all these mental gymnastics that, we didn't need a calculator to figure this out. We could just look at one thing real quickly and get an answer. Right? Go ahead. Sorry.
So one thing that I actually use synthetics for is to determine what the interest rate is implied in those options.
That's a good point.
And a lot of times, like, I know this is probably not like the official term for it, but you could almost do a synthetic bond if you were to get a synthetic short and buy stock. And that would, and if your choice is either owning a bond, which is a little bit less liquid, especially when it's off the run, or doing a fully hedged, like long stock, long position that doesn't have dividends, interest rate, that kind of thing. You could be a little bit more liquid in your interest rate collection by doing this. I mean, that's just a thought on how you can apply the synthetic to your own portfolio.
Yep.
Totally. When inflation hits or something like that, or bond prices, you're expecting bond prices to, go down or something like that. So interest rates go up and you want that kind of interest rate capture, you can do a fully hedged synthetic short.
Right, for sure. One more little point here, Mark. Do you want to add something there? Sorry, I interrupted.
No, I just totally agree about your point earlier about how understanding it starts to help you see all the other relationships across the market and getting good at that mental math and, seeing proportionality and, ratios of this spread to that spread, or think about it in a model perspective. There are all kinds of different, how you can analyze the curve.
Let's look at one more. I said I wasn't going to talk about boxes, but I am, because this is interesting. Okay. Remember the box theory, right? So let's look at the 220, 230 box with these prices. So if I buy this 220 line, I'm buying the synthetic, let's call it, I'm buying long stock. That means I'm going to be long this and short this. Okay. I'm going to sell the 230 line. So I'm selling stock at 230 and I'm buying at 220. Who's going to let me do that for a $10 ARB? No one, right? So let's see what happens when we add these prices up. I'm buying the 640. I'm sorry, buying the 220 call, selling the 220 put, selling the 230 call, buying the 230 put. That is a $10 box. The strike difference is 10. I am doing synthetic long stock on the bottom strike. I'm selling stock on the upper strike, right? This should be around $10. Let's try it. So what is 640 minus the 70 cents up top, right? I'm doing it on the calculator because I'm a mental case. 570. So I'm paying 570 for that call debit spread. Now I'm going to buy the put debit spread. That's going to be a price. I'm guessing it's around 430 without even looking at it. 470 minus 0.4 is 430 plus the 570 I paid equals $10. That box is a $10 box and the prices line up to be 10. Now it's going to be about $9.95 at 10.05 with interest rates and that sort of thing. It's going to be in that ballpark, a couple pennies under and a couple pennies over, give or take. But if you look at expiration anywhere along this curve except at a strike, okay, and that's another story, you will be netted out to zero, okay, because your longs and shorts will net themselves out to zero. That's why this is a flat line risk graph, okay, except for pin risk with equities, not in the SPX, but with equities. Comments, anything, guys? Make sense?
Yep.
So that's why these relationships are so cool to learn, because right away that box has to exist, and the 220, 225 box has to exist too. That's a $5 one. I'm guessing those prices add up to $5, right? So.
Yep. Good guess.
Lex, I don't think there's anyone that loves synthetics more than you do.
I love.
I really see just the passion.
Oh, dude, I'm telling you, I can't tell you. And they go across time and everything. It's amazing, these synthetics. It's unreal. And I was so happy to learn because, I used to sit in the trading room when I was a young clerk. And I might have been even a young trader. I can't remember. But he would talk to the guy who invented conversions on the SIBO. Okay. This is in the early 70s. And I wasn't there then, but, they were talking about it. And I got to learn, just absorb. I didn't even get to ask questions. I just got to listen. They let me sit in there and listen to talk about these relationships and how crazy it was that they were able to lock this money up and no one knew about it. I'm like, this is insane. And they were just almost like giddy about it because they understood this relationship and they figured it out. And then it just moved into baskets in the OEX. And then they did these huge rolls. And I was like, oh my God, it was an entire business.
And then they told people about it, and there goes their edge.
There goes the farm, right? And then the computers came, and they figured it all out. So, any capuche. All right, that was good, guys. I appreciate it. That was fun. Make sure to send us comments, subscribe to the Tradier Hub YouTube. Guys, give yourself a plug. Go ahead, Jason. Go first. Let's hear it.
I'll do www.vol.land for a dealer positioning dashboard in terms of Greeks.
Awesome. And Mark?
I'm actually writing something very close to what we talked about with synthetics today. And check me out at thetil.substack.com to read more about this.
Perfect. And then harvestedfinancial.com for you as well, right?
Yes, sir.
Let's do it. All right, guys. Good seeing you as always. Great show. Have a great weekend. And
happy trading.
Happy trading.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.